Ever since I mastered this price action trading strategy, I've been profitable consistently. And honestly speaking, if you are starting out as a forex trader and you are looking for the best trading strategy that is going to be sufficient for you, that is going to help you to become profitable in the long run, then this strategy that I'm about to share with you in this video is the best bet for you. So my candid advice for you guys is to make sure that you watch this video from the beginning to the end. Do not skip any, because you are going to learn a lot of valuable information in this video. When we talk of price action simply means when you analyze the market using the data from the price chart. Candlestick has been the major style of analysis, because there are other style like the line and other thing, but the Japanese candlestick has been the most important chart pattern that is used to analyze the market. So many traders are using the Japanese candle to analyze the market. So if you open your chart, you are going to see two candles, a green candle and a red candle. They are forming consistently depending on the time frame that you are using. If you are using 10-minute time frame, or let's say you are using 1 hour time frame, it means that each candle will be formed every 1 hour. So that is how the time frame is being calculated. So when you see a green candle, it means that the market was bullish at that period. And if you see a red candle, it means the market was bearish at that period. So what differentiates the colors is the direction. So when the candle ends up in a green, it means the market is bullish, and when the candle ends up in a red, it means the market is bearish. So this is the easiest way for you to understand a candlestick chart. So once you understand candlestick chart, you can be able to trade price action profitably. And like I said, trading price action doesn't require any indicator. You just trade the pure naked market. So what I'm going to teach you in this video is a simple guide on how you trade price action profitably. So now let's assume you are a trader. The first thing you have to do is to look for a pair that you want to trade. It could be Euro USD, it could be GBP USD, it could be USD AUD, or any pair at all. Once you have been able to pick up a pair that you want to trade, the next thing you are expected to do is to look for a time frame that you want to use. So it depends on the kind of trader you are. If you are a day trader, you might decide to use the 1 hour time frame for your technical analysis, and then use the 5-minute time frame for entering your trade. So but if you are a swing trader, you might use the daily time frame for your technical analysis, and then use maybe the 4-hour time frame for your entry. And if you are a position trader, you can use the weekly time frame for your technical analysis, and then use the daily time frame for your entry. So it all depends on the kind of trader that you are. So let's say, for instance, you are a day trader and you are trading off the 1 hour time frame using 5-minute time frame for your entry. So what you're going to do is you're going to open the chart on a 1 hour time frame, because that is where you are going to analyze the market using the 1 hour time frame. So your pair could be Euro USD. So once you open the chart Euro USD, then you now look for 1 hour time frame and make sure the time frame is 1 hour. Then once you have been able to get the time frame and the pair that you want to trade on, the next thing is to look at your risk management and your money management. So it depends on your capital. Let's say, for instance, your trading capital is $10,000, and 1% of $10,000 is $100. So what you're going to do is you're going to look for a lot size and a stop loss that equals to $100. Let's say for instance you use 0.50 lot size with 20 pips stop loss. So in this sense, you are using 0.50 lot size and then your stop loss is just 20 pips. Then what could be your take profit? Your take profit could be 1 to 3 risk reward ratio or 1 to 5. Let's say for instance you want to make use of 1 to 5 risk reward ratio, right? So that means your stop loss is 20 pips while your take profit is 100 pips. So now you have been able to get the money management and risk management style, which means you are going to risk just $100 per trade. So you are risking $100 to make $500, which is what? 1 to 5 risk reward ratio. So now the next thing you have to do is to look at what? Price structure. The price structure is the next thing you have to look at. So how do you identify the price structure? You look at the price chart to know what the market is doing. So if you look at the price chart and you see that there is a series of higher high and higher low, higher high and higher low, that is the candlesticks are making higher high and higher low, higher high and higher low, it means that the market is clearly in an uptrend. That means you are expected to only buy. But if you look at the chart and you see that the market is making lower high and lower low, lower high and lower low, lower high and lower low, it simply means that the market is in a downtrend and you are only looking to sell. But in the sense that the market is making highs and low, highs and low, highs and low, right? It means the market is in a sideway because the market has a particular resistance level where it reverses from, and the market has a particular support level where it reverses from. So in this scenario, you are looking to buy and sell. You buy at the support level and you sell at the resistance level. So this is what we call the market structure. Once you have been able to identify the price chart, you will now be able to know what to do. Now let's assume that you look at a chart and you identify that the market is making series of higher high and higher low. You have confirmed that the market is in an uptrend. So you are now looking to buy. So now the next thing is to look for an area of value. An area of value is either a support or resistance level because it is a value, because it is an area where price tend to reverse, where there is a pressure. So for the fact that the market is in an uptrend and you're only looking to buy, the lows becomes your area of value because that is what is acting as a support level. As the market is making series of higher high and higher low, higher high and higher low, so you only target the lows. So what you do in this scenario is to plot out a trend line and connect the lows. You connect the lows using a trend line. You connect the lows. So what you are doing is you are waiting for the price to make a pullback to the lows for you to take a trade. So in this scenario, the trend line now becomes your area of value. Or you can also use a moving average. A moving average is dynamic. It moves alongside with the price. So it depends on the kind of market that you are in. If the market is in a strong uptrend, you can use the 20 exponential moving average. And the moving average will be acting as a dynamic support alongside with the trend line. So what you will do is you plot out the 20 exponential moving average, then you also draw a trend line connecting the lows and extend it to the future. So once you have done that, what you have to do is to exercise patience and wait for price to make a retracement to the moving average or the trend line. Do not take trade when the market is still going up, up, up. You have to exercise patience and wait for the market to make a retracement, to make a pullback to the moving average or the trend line. So that is what you are expected to do. So once the market now makes a retracement to the moving average, it means that the market has entered into an area of value. So now the market has entered into an area of value. The next thing you have to do is to wait for a price rejection at an area of value. In other words, we call it reversal candlestick pattern. So what you are looking for is a bullish pin bar, or in other words, you can call it a hammer. So what you need is what you are waiting for, you are waiting for the price to come to the support level, that is the trend line, get rejected, and form a bullish reversal candlestick pattern. So what you are looking for is what we call a bullish pin bar. You want the price to come to the moving average or the trend line and then get rejected, forming a hammer. You know how a hammer looks like. So you are waiting for the price to come there and form a hammer. So once the price is able to form a hammer, that confirms a bullish reversal candlestick pattern. That becomes your entry trigger. This is what will trigger you to enter a trade, telling you that there is a strong rejection at this level, which means this is the time the buyers are stepping in to push the market up. So that is when you are expected to place your buy trade. At the close of that hammer, you place your buy trade, and your stop loss will be below the trend line or the moving average, because in this scenario the trend line or the moving average is now acting as a dynamic support level. So your stop loss must be below the trend line. So now where are you going to target as your take profit? That is why I say you use the higher time frame for your technical analysis and the lower time frame for your entry. So you target the level that the price reversed and started making a pullback. Remember, the market was going up, up, up. There is a particular level where the market got to and then started making a pullback to the moving average or the trend line. So that level where the market reversed from should be your target take profit. So that will be the level where you're going to put your take profit, so that when the market now goes up to that level, it will smash your take profit. So don't be greedy in the market. Always have a take profit in place so that you can be able to get your take profit. So once you are able to do all these things that I've stipulated in this video, you'll be able to trade price action profitably. So once you can consistently do all these things on a chart, you'll be able to make money profitably in the forex market. So this is the easiest way to trade using price action. So once you understand this, and once you remove greed from your mind, you'll be able to trade the forex market profitably. So my candid advice for you guys is to go to your demo account, use this instruction and implement it in your demo account and see how it works. Once you get it right, you get it perfectly, then you can now implement it in your real trading account. Once you are able to do this daily, consistently, you'll be able to build a powerful price action trading strategy. With this, you don't need any other strategy in the market. What you need is just your trading psychology, how to control your emotion, money management, risk management, and so on and so forth. But your strategy is just pure price action. You don't need any other strategy. This is what you need to succeed as a forex trader. So ladies and gentlemen, that is all I have for you in this video. I hope you love this video. If you do, give us a thumbs up. Don't forget to subscribe to my channel for more educative content like this, and also don't forget to turn on the notification icon to be the first to be notified whenever I drop new content. I will see you again in my next update. Enjoy the rest of your day. Goodbye.